in this particular video, we're going to focus on how you can go about determining your risk tolerance. And we're also going to cover a little bit about risk capacity as well, because those two, even though they sound the same or similar, they're actually quite different. And the reason why this is really important is that if you're working on building, financial wealth, it is very crucial that you understand your risk tolerance to start with, and over time understand how your risk capacity changes. So if you're new here, welcome. If you're a returning subscriber, of course, thanks for tuning in. One thing I would say is this channel strictly focuses on finance. I know I started this channel out as a mix of the two, of aviation and finance, but I've intentionally focused this channel on finance because I have another channel for aviation. If you're interested in that, just check out Steven Aviate, AV8, all right, Alpha Victor 8. Okay, so you can check that out. But for this channel, like I said, it focuses on finance. So let's get into what we're going to talk about. Now, I'm going to start with this. Let's show you some data, all right? It's important to start with data because you get to know why it is important to understand this from the get-go. So this is from Charles Schwab, all right, the big investment company, bank, whatever. And they do have a lot of information that they share. Now, this information isn't quite the latest one. They have more inside information that you can look up. But the knowledge that I want to pass on is the same, whether you're using the most recent data or an older data, all right? So this information shows what an hypothetical performance for conservative, moderate, and aggressive model portfolios were for an investment hypothetical performance between 1970 to 2014. Now, remember, we had a lot of cyclical economic activities. I'm talking about both the booms and the busts, okay, or recessions within this time frame. And it is important to highlight that because depending on what type of portfolio you hold or have during these times would definitely determine how your portfolio perform, the kind of investment you hold. So let's start with asset allocation. We have stocks, bonds, and cash. A lot of people, sometimes focus on a lot of stocks. They want to hold a lot of stocks. And in as much as this is great, because depending on the percentage you hold in your portfolio, your performance could be really good or could be really bad, depending on the economic factors, right? And here, if you have a conservative portfolio, you're probably holding about 30% of stocks. And if you have a moderate portfolio, you're probably holding 60% of stocks. And if you have an aggressive portfolio, you probably have about 80% or more allocated to stocks. For bonds, you probably could have, for a conservative, you could have about 50%. Generally, bonds are generally considered safer, but at the same time, the returns can be very low. Now, for a conservative portfolio, understand that this is usually good for people that are nearing retirement or just looking for cash or preservation of their investments. Okay, so they're not really looking for growth anymore. They're just looking to preserve their investments. You could look into moderate portfolio if you are somewhere in the middle between aggressive and conservative. So you want someone that still wants some growth, but not aggressively looking for growth. So moderate portfolios would have, say, 60% stocks, 30% bonds, and 10% cash. And of course, aggressive portfolio would mean that you have 80% stocks, 50% bonds, and 5% cash. Now, why is this important? The reason why this is important is because if you are starting out your investment journey, all right, a lot of times we don't allocate our investments properly. What isn't tracked isn't measured. If you cannot track it, you can't measure your progress. Simple Excel sheet would do the job, and you can literally do a lot of numbers with this Excel sheet. Make it as fancy as detailed as you want it to be. But the point here is you are able to be in control of what you put down on paper or on this Excel sheet. And I use it for things that are as simple as just, minute things like this. All right. And the reason why I'm showing you is that, I calculate every little bit of money that I get, whether it's $1, whether it's $2, whether it's $3, I put it on an Excel sheet. It's an income, whether it's $1. $1 is a lot of money, especially where I'm from anyway, Nigeria, right? So the point here is I put those numbers down because I try to track, okay, my income. Same thing is what you want to do with your investments. You want to track it. And, a lot of these apps out there nowadays, they're able to give you a lot of detailed information on your performance, on your stocks or bonds or whatever investment you hold. So I encourage you to do the same. And with your ability to track your investments, you can easily tell, okay, how much do you hold in cash? How much do you hold in bonds? How much do you hold in stocks? By the way, you can add more to this asset allocation. You can add real estate. You can add gold, silver. You can add cryptocurrencies. The list can go on. These are all alternative investments that you can consider depending on your risk tolerance. Now, nowadays, some people are doing crypto. I do a little bit of crypto, very little, right? And that would be considered very high risk. And that could change my risk capacity or my risk tolerance. And I will talk about the difference between risk tolerance and risk capacity shortly. Going to the hypothetical performance, all right? For the conservative portfolio that started with $10,000, at the end of this period, at the end of 2014, this portfolio grew to about 389,000. By the end of 2014, the moderate portfolio grew to about 676,000, and aggressive grew to about 892,000, with an annualized return, right, of about 10% for aggressive, 9.8 and 8.1. So you can see even with a conservative portfolio, you still saw some growth if that is what you had during this period. And an analyzed volatility, standard deviation was around 9.1, 15.6, and 20.5. The point here is, look at these numbers down here. All right, maximum loss that occurred during this period, 1997 to 2014. On a conservative portfolio, the maximum loss they ever had was about negative 14%, with a moderate about negative 32.3, and aggressive about negative 44.4. The question is, if you woke up one day and you noticed that your portfolio had dipped by almost 50%, what would you do? Would you panic? Would you think this is an opportunity to buy? Would you sell all your investments and get out of the market and say that the stock market is rigged? Because I remember, even though I was really young, back in 2001 or 2008, I was quite young then, I was still in college. A lot of people, killed themselves, right, during those economic downturn periods, and committed suicide and all that stuff. So if you do not understand what your risk tolerance is, you can find yourself in those kind of situations. And I understand not everybody is able to measure their risk tolerance appropriately. And this is where it is crucial to educate yourself and become informed. And if you cannot do that yourself, or you feel like it's too complicated, go talk to a financial planner. There are so many of them on, just search on Google. You'll find a lot of this information almost for free, even on YouTube, almost for free. And they would, the importance of getting that personal touch to the guidance you get is that, in comparison to getting free videos like this or watching different videos online, is that you are able to sit with somebody, they're able to discuss these options with you, and that can often change how you perceive your financial situation, and that is really important. So with this information that I've just shared with you, as you can see, holding an aggressive portfolio means that you have a very high probability of losing almost 50% of a portfolio at a particular time. I mean, it could be more, it could be less, right? And if you do not understand that from going in, you will likely do the wrong things. Now, generally speaking, if you have been well informed and you know that you have an aggressive portfolio, there's probably a reason why you did that. It's probably for growth, which means if you found yourself in a position where you could buy more shares or accumulate more of these good shares in a dip, right, that is almost 50% of loss, at least on paper, then you know that that's an opportunity to buy. On the other hand, if you have a conservative portfolio and you saw yourself lose 14% it's not much of a big deal, right? It's only 14%, even though it's a lot. But at the same time, you know that, okay, in this situation, I haven't lost much. You can ask yourself, do I want to buy more? Do I want to keep things the same? Or do I want to sell some of the shares that I don't want to lose on? So that's also important to think about. Not all shares will continue to grow forever. So that's something to keep in mind. Now, let's talk about risk capacity. The aspect of risk capacity is to think about it in the terms of how much of loss can you withstand and how long can you go in this process. So a good example is, let's assume that you invested $10,000, all right, and you're thinking to yourself, this $10,000, I won't need it, right? You remember, you already have an emergency fund. You've already invested some monies for savings on the side, and now you have $10,000 that you've invested in whatever stocks, bonds, whatever that may be. That means that if for any reason you exhaust your emergency fund, you exhaust your savings, the next thing that may come in line is maybe your investments, where you might need to sell to raise funds for whatever reason. Because remember, life happens, accidents happens, people get sick, things like that. People that are important to you may need your help, and you may need to sell those investments. So your capacity really is how long can you go without having to touch your critical investment. Or your capacity could also mean how much loss are you willing to bear in a particular portfolio before you hit the sell button or get out of the position. It all depends on what you do. If you're an active trader, if you're somebody that trades on a regular basis, then you may need to consider, okay, if this particular position gets to, if I lose maybe 5%, then that's my exit strategy. That's your capacity, your maximum loss for that trade. If you're an investor that invests long term, then you can look at it as, okay, this investment, I don't plan to touch it. In fact, I don't even plan to look at it for the next 5-10 years. I'm just investing. I'm putting money into it without really considering any form of growth or anything, because I just believe long term. Now, since you have a long-term plan for that portfolio, the question is, how long can you go without touching that money if things got really bad? And that's where your emergency fund comes in. That's where maybe your savings comes in. Because remember, if you have those, think about them as opportunities to, like lifelines, right? To survive, opportunities to survive. If you have those lifelines available to you, then you don't have to touch your investments. But if you don't have those lifelines, those funds that are liquid cash ready to be accessed or accessible to you, then you're forced to go into your investments, which means whether the time is good, whether the time is bad, you may be forced to cash out. So that's really what your capacity is. Now, capacity in comparison to risk tolerance changes. Some months or some years or some phases in your life, you may have more capacity to withstand, to go maybe 6 months or 1 year or 2 years without touching your investments. Ideally, right? Nobody wants to touch long-term investments. You kind of want to keep them long-term. But if something were to go wrong, do you have the ability to go as much as possible? And hopefully you don't even have to touch it, because you're able to recover from whatever situation you find yourself in. And it's crucial that we think about this as we get into our investment journey, right? And that's why they always say, before you even start investing, pay off your debt, right? Take care of the necessary credit cards and loans and things that are maybe slowing you down. Okay. Once you get rid of debt, then the next thing is, okay, you want to make sure that you have some emergency fund. And even before you start paying off debt, you should have emergency fund. But then let's work on savings. Your savings should be maybe 6 months worth, a year worth of expenses. That's not emergency. Emergency fund could just be things that you need. You need a quick $1,000, $500 to do something that just came up. You blew a tire or something like that. But your savings should hold, maybe 3 months worth of living expenses, or 6 months worth of living expenses. Again, this goes back to your capacity. Okay. How long can you go before you would need to, or you might have exhausted your savings. If you exhaust your savings, what's the next line of action, next lifeline that you may have? That may be brokerage accounts, maybe followed by the next thing will be retirement accounts. Now, ideally, you don't want to touch all these ones, but just in case things got bad. I hope that you found value in this one. If you have, don't forget to drop a like, don't forget to subscribe to the channel, and I'd love to see you in the next one.